PNB Housing Finance reported its earnings and good set of earnings. The net profit has gone up by about 45%. Net interest income has gone up by about 29%. And they've reported improvement in a couple of metrics, including the asset quality and margins. So to talk to us more about the earnings, we have the MD of the Housing Finance Company, Mr. Sanjaya Gupta. Sir, hi, festive greetings to you. So to start with, could you talk to us about major developments in the quarter that led to the improvement in your earnings?
See, as I keep saying, mortgage business is an annuity business, and it all depends on what you acquire, what you underwrite, and how you deliver and manage your portfolio. So if you would recall, last year has been a sterling year for us when it comes to business. Q1 and Q2 have been decent this year. And hence, our top line improved, our margins improved, our basically our OPEX, because of the size of the organization and because this year we are not doing any new infrastructure build up or opening new branches, has compressed. And hence, the profit or the delivery of the bottom line of the company has given a significant rise over the previous, I would say, quarters. And this is a business which, if managed properly, can give you a long-term return. And you have to be just patient, and you have to keep on managing the portfolio that you are having on your balance sheet. Plus, do not keep on looking for growth figures which are, in challenging times become concerning afterwards. And that's about it. So doing sensible business and being conservative is the way to approach this business, and particularly in this year.
So one of the concerning points for your business had been the asset quality, and I've been speaking to you since last few quarters, and there's been a consistent effort to improve the same, and that is getting reflected in this quarter as well. So give us more details about how things panned out in both the corporate asset quality, the retail asset quality, and the outlook as well.
See, if you were to say on the corporate side, it is not fill it, shut it and forget it business. You have to keep on monitoring your projects, your developers, their cash flows, their sales, their collection efficiencies, their escrow mechanism, compliances, etc. And our team has been wonderful in doing so, especially because we are not acquiring any fresh corporate loans this financial year. The team remains intact, and the team is they are demonstrating a very high level of ownership, and they are monitoring it with girth, which makes me very proud. And that is why there are no forward flows. As we have talked in much detail, there are 6-7 accounts, and we have started seeing part of resolution in those accounts also. So on the corporate side, I would say it's a steady state, and from going forward from here, I think resolutions will be faster, because we have been looking at a lot of legal angles, etc., getting new investors, developers into these projects. And I think during Q3 and Q4, resolutions will be the call of the day on the corporate side. On the retail side, let me be candid. We are seeing that a lot of developer projects across the country are getting delayed because of credit flow, not because of the developer. Because the financial institutions are not honoring their commitment to disburse on the corporate side for those projects. And hence, we have stayed away from under construction property on the retail side. And we have been doing this consistently ever since, I would say, Q3 of financial year 18, because we could envisage slowdown on deliveries. So that is giving us results now. And I think even on the retail side, we should be able to maintain the asset quality that we have today. And together at a portfolio level, even at the end of this financial year, we should come out as one of the best portfolio qualities in the industry.
So help me with some quick numbers here. So where do the retail NPAs stand at, and the corporate NPAs as well, and the comparative QOQ figures?
Well, the retail NPAs on portfolio are at about 84 basis points, and the corporate NPAs on portfolio are 83 basis points. And together, I mean, if you were to say on the entire portfolio is 84 basis points. And going forward, I think if we are able to, and we are carrying a very significant ECL provisions for these type of NPAs, and thanks to the corporate tax reduction, we took the benefit of that and have provided additionally in this quarter for the ECL. Plus, we have also done a contingency reserve enhancement by 12 crores, and I think it is a stable state. I will not like to comment on the industry because those numbers will come from the research houses.
Okay, so one of the concerns, not just for you but for the industry, is that the wholesale NPAs may actually rise as the RBI moratorium comes to an end. So how much of your corporate loan exposure is to the accounts which are currently under such moratorium?
Okay. See, moratorium doesn't mean that the interest incidence is capitalized on the account. The interest always gets paid from the cash flows of a project. Just to give you some figures, when we started this year, we had 67% of our portfolio which was under principal moratorium. As we are speaking, that number has come down to 53% because the moratoriums are dynamic. If we were to say how much how much of portfolio shifted to principal repayment stage, it is something like 1200 crores. And to comfort a person like you, even during principal moratorium period during H1, we have collected something like 225 crores as principal repayment because the cash flows on those projects were in excess to what was projected. So please, I mean, take me for my word that principal moratorium does not mean capitalization of interest, does not mean that whatever cash flow comes into the project goes to the developer. There are sharing ratios during moratorium and post moratorium period, and if the cash flows, the gross cash flows are in excess, even during principal moratorium period, there is a principal repayment, as I just gave you a figure over the last 6 months.
Sir, I understand that one of your largest corporate exposure is to the Lodha group. So I believe that you are the single lender to that particular project. But for the benefit of viewers, shareholders, what would you say to allay those concerns?
So there are no concerns as far as those facilities go. These are the fourth and the fifth facilities that we have given to that developer. The projects are going on schedule. There is no, I would say, approvals which are pending. The sales are as per our projections. The cash velocity or the cash collection efficiencies are as per those our projections at the time of sanction. And both these accounts are zero DPD from inception till date. And we are looking that from Q3 and Q4, the cash flows or the cash efficiencies are going to be in excess, and there might be a probability of even making principal repayment during moratorium period.
So lastly, by next Samvat, do we expect the things to improve, the environment to improve for your company, for the housing finance companies on the whole?
Well, I only pray for the entire sector because we are elements of the housing finance sector. So I pray for the construction or the housing sector as such. And I'm sure that we will see better times in the next somewhat. And I'm sure that liquidity infusion, rates of interest will get transmitted to the sector, because this is also the largest employer after agriculture, and the bottom of the pyramid demography of our country gets employment. And we have to think as a country, as a nation builder in totality and not in isolation.
Mr. Gupta, thank you so much for the interview, and once again a very happy Dhanteras and a very happy Diwali to you.
Happy Dhanteras and a happy Diwali to all the viewers and to your crew.
Thank you.
Thank
sir.
you.
Thank
Thanks
you.
a lot.